Well, if all the analysts, we have yesterday event here at MSCI, and all the analysts from Europe were there, and the doors were closed, and we talked to each other and said, well, it ends up all in Dubai. And the story will be the Iran case and the trading activities explode. Don't get me wrong, but I think before one investor comes from a CBD in Turkey to a secondary location, he would further go to Kazakhstan or wherever. So I don't think that we will see the kind of a capital flooding into second tier and third tier locations. For sure, there are some explanations. But I think, no, the competition will increase dramatically the next 2 years, totally in line with you. And we accept higher prices due to our new understanding what is the risk in these days on that. I don't see in the middle of nowhere. I think Martin and myself worked for DeFi, worked for Digi, and we end up in, I think, in Milton Keynes 08, and these gentlemen said, stupid German money. Yes, sure, maybe. I don't think this will happen. Again, for sure, mistakes will made, but the mistakes will be in the city center, investment centers of the countries globally, and not in the middle of nowhere. I don't think so. Second thing is why. Why is I see an increasing pressure, Norwegian pension fund, GIC, all these things we have the experience made the last 5 to 7 years in stock and fixed income industry on corporate governance, of sustainability out of all these certifications. This will also shake up our industry, positively speaking, in new kind of regulated investment strategies or split up the market. This is again where I see things will come up. And the Norwegians, again linked to my Nordic company, the Norwegians, they have so much power meanwhile to change thinking in making investments in real estate. This is incredible. Again, the normal market goes on, but this will change the next 5 to 10 years dramatically in our understanding. By the way, they wouldn't make an investment in Austin, Texas with the oil industry. They kick it out, no-go ground. This is again what I see. Sounds negative, but as long as I see it, that will coming to us, then we can find some answers on that. But again, Ben, it end up all the CBDs and all the big famous, well, say, cities in the world. I think so.
But we were talking about sort of moving to secondary property. There are other ways of getting into markets. You know, one of the groups who are raising capital for at the moment is the biggest buyer of NPLs in Europe. And a lot of the investors that we go and see with that group say, well, isn't it over yet? And they just smile. Ireland, UK, getting to the end, but the rest of Europe has only really just started. So there's a lot of opportunity out there in taking different kinds of risks in large portfolios and then filtering out the, improving the real estate and then selling it on. But from a capital raising point of view, the best managers with the best track records, I guess it's always been this way, but it's even more polarized now. So particularly in Europe, there's a Premier League of value-add opportunistic managers who can raise money extremely quickly and then actually deploy it extremely quickly. So I'm not going to name any names. 1 or 2 of them have raised, say 2 years ago, raised $1.5 billion and have already deployed it and will now begin to harvest it. And those managers are now raising the next fund with a slightly different strategy. So the capital for that kind of in and out strategy all over the world is there, but they're being very, very careful on who they invest with. Only the best with the right track record. And the tricky bit of our job is making sure we know where the line is between the manager that'll raise well and quickly and the one that just sits below that line, and it'll be, as we would call it, a heavy lift. I think that line will lower as more capital tries to force itself into the pockets of good managers who will then deploy quickly. But I don't see that happening dramatically yet. But let's see.